Adam Shapiro, Fox Business. Chair Yellen, a month ago you delivered a speech in Wyoming in which you said the balance of research suggests that the core reforms we have put in place have substantially boosted resilience without unduly limiting credit availability or economic growth. I have a two-part question based on that quote. First, what message do you want Congress and President Trump to hear from that statement? And then regarding economic growth, the accommodative process that the Fed has followed for the last 10 years has helped bring us to full employment. But economists point out that there have been people who haven't benefited. For instance, 52% of Americans own stock, 48% don't. They've not participated in the gains in the stock market. Housing prices, the median house price is now at a record high, and 39 million Americans, according to a Harvard study, spend more than 30% for housing. So what would you say to those people about Fed policies and the impact they've had on their lives?
Okay, so you asked me what was the main message of my speech, and I would say it's that we've put in place since the financial crisis a set of core reforms that have strengthened the financial system, and in my personal view, it's important they remain in place. And those core reforms are more capital, higher quality capital, more liquidity, especially in systemically important banking institutions, stress testing and resolution plans, and those four prongs of improvements in banking supervision have really strengthened the financial system and made it more resilient, and I believe they should stay in place. But I also tried to emphasize, and I believe that they have contributed to growth and the availability of credit. I've also tried to emphasize that all regulators should be attentive to undue regulatory burden and look for ways to try to scale that back. And this is especially true after years in which we have implemented a large number of complex regulations. And we have been committed to doing that. I would point out particularly community banks that are laboring under significant regulatory burden. We have been looking for ways to scale back burdens, run in the GRIPR process where we've listened to concerns among community banks and are looking for ways, for example, to simplify capital standards and reduce burdens, and that's very important. More generally, we want to tailor, we want to, and we would like to see Congress as well. We can do things to appropriately tailor regulations to the risk posed by different kinds of banking organizations. There are some things that Congress could also do to help that process, and we have made some concrete suggestions. And then some of the regulations that we've put in place with other regulators since the crisis, like the Volcker rule, are really quite complex. And we're working, we believe we should, and we're working with other regulators to try to see if we can find ways while carrying out what Dodd-Frank intended, that banking organizations not be involved in proprietary trading. Nevertheless, the implementation can be less complex. So that was my main message. Your second question asked about what impact the Fed has had on income distribution because of the fact that stocks and homes tend to be disproportionately. So I would say, look, we were faced with a huge recession that took an enormous toll in terms of depriving large numbers of people, and disproportionately lower income people who were less advantaged in the labor market found themselves without work. We had a 10% unemployment rate, and our congressional mandate is maximum employment and price stability. So we set monetary policy not with the view toward affecting the distribution of income, but toward pursuing those congressionally mandated goals. And I am pleased to see the unemployment rate and every other measure that I know of pertaining to the labor market show dramatic improvement over these years, and that is hugely important to the economic well-being, not at the top end of the wealth and income distribution, but to the bottom end of the income distribution. And we have seen this year median income in real terms rise significantly with gains throughout the income distribution.